Well, hello everyone, it's Peter Schiff. This is Tuesday, March 2nd, 2010. Well, yesterday we got some more data on personal income and spending that once again got people on Wall Street excited that the data was confirming their false belief that the U.S. economy is actually recovering or growing. And the data came in the form of higher than expected consumer spending. Consumer spending increased by 0.5%, not inflation adjusted. But that was higher than had been forecast. And the market said, hey, this is great news. Consumers are out there spending. Well, where were they getting the money? The savings rate plunged. Personal income was only up 0.1%. That was less than expected. Savings plunged. The savings rate is now down to 3.3%. It's the lowest it's been since mid-2008. And it looks like it's on its way back down to zero. The fact that we're depleting our savings to go out and buy more things that we can't afford is no reason for Wall Street to celebrate. Remember, that is why we're in so much trouble, because we bought things we couldn't afford. Americans went out and bought all sorts of consumer products they couldn't afford. We exploded the trade deficit. We bought all sorts of houses we couldn't afford. And now the government is spending all kinds of money on programs that we don't need and that we can't afford. And none of this is good news. And obviously, we cannot sustain an economy based on depleting our savings. How long can that go on? I've said many times on this blog, what we really need to have lasting economic growth is consumers to stop spending and start saving. Because only when consumers start saving can businesses start investing and start hiring. But of course, none of that's going to happen until we reform Washington and until we change Fed policy that's still keeping interest rates down at zero. Also, I wanted to comment on the blog on Friday. I mentioned about the guys at AIG coming back with bigger losses and asking for more bailout money. What happened later in the day on Friday was that Fannie Mae came out and made the same announcement. Not only do they have horrific losses, but you know what? They want more bailout money as well. I guess after paying themselves all these hefty bonuses, they've kind of run out of money, and they need to refill the till there so they can rake out additional bonuses. And of course, earlier in the day, I did comment on the fact that after losing so much money, securitizing and guaranteeing interest-only mortgages, these geniuses at Fannie Mae finally decided that it didn't make sense to guarantee these loans, given how many people weren't paying them back. Well, I could have told them that, and I did tell them that years ago. The fact that it's taken them so long to figure it out, these guys shouldn't be getting any bonuses at all. They should have all been fired. If there isn't a better reason for abolishing Fannie and Freddie, it's their own incompetence of their executives to take so long to stop securitizing and guaranteeing interest-only mortgages when it should have been obvious a long time ago that they shouldn't have done that. Speaking about some of the obvious problems, finally, it looks like investor attention is no longer centered on Greece and the problems that it might portend for the euro. They're now looking further north and outside the eurozone at the UK. Now, the UK also has a lot of problems, which is one of the reasons why we have very little, if any, money at all invested in the UK with clients at Euro Pacific Capital. We've basically avoided UK investments for the reason that the UK experiences, I think on a smaller scale, many of the same problems that we have here in the United States. But of course, right now, investors are working their way up the food chain of indebted nations. They've moved from Greece to the UK. I think the UK is roughly 5 times the size of Greece in terms of population. So certainly it's not going to take long for the investors and the bond market vigilantes to work their way up the food chain and get all the way to the top, which would be the granddaddy of all, the biggest deficit monster on the planet, which is the United States. And obviously, our turn is coming, and I think it's coming soon. I think all this focus on sovereign debt risks, on budgets, none of this is good for the United States. The fact that right now we all think that we're immune because the dollar has been strong, well, the dollar hasn't really been strong. First, the euro was weak, and then the pound was weak. But it's not really dollar strength. Look at the Canadian dollar. It's almost at a new 52-week high. It's up sharply today. It was up quite a bit on Friday. The Australian dollar, they just raised interest rates to 4% the other day. The Australian dollar is almost at a 52-week high. That currency's been strong. Look at the price of gold. Gold has been a lot stronger than the dollar in terms of the British pound or the euro. Look at what gold is doing against the dollar. Gold is up right now as I speak. The market isn't closed, but we're up just over $20 an ounce on gold today. We're back over 1,100 in the cash market. Look at oil. Oil prices have held up very, very well. Oil is up over $1.50 a barrel today. It's back over $80 a barrel. Think about how high oil prices are right now in terms of British pounds, in terms of euros. So what we're seeing is paper currencies losing value against gold, losing value against oil. And we're certainly seeing creditors around the world starting to focus and pay attention to sovereign credit risk. And obviously, what's happened over the last year around the world, but certainly in the United States, mostly here in the United States, is a lot of the debt that was burdening corporations, a lot of the bad debt that was on the balance sheets of our banks has simply been moved to the balance sheets of Federal Reserves. It's now on the government's books instead of the private sector books. And in addition, in their foolish attempt to revive a phony economy, the government is trying to force-feed spending into the economy by deficit spending. The government is simply running up deficits so that Americans can keep spending money, but now instead of accumulating more private sector debt to do it, we're accumulating more government sector debt, and these debt to GDP ratios are running off the charts, and people are wondering whether or not governments are good for it, and the creditors are getting nervous. They're getting nervous in Greece. They're getting nervous in the UK. Believe me, they are going to get nervous in the United States. There's no question about it. And at the rapidity with which these worries seem to be spreading and moving up that food chain, it's not going to be long before the full attention is focused right here on the United States, especially when people start to look at a lot of the economic data and start to appreciate that we're not recovering. When you see the big losses coming out of companies like AIG and Fannie, when you see the news coming out of commercial real estate, now coming out of housing again, when you see the jobs data, we're getting more jobs numbers, I think, on Friday. I still think we're shedding jobs, particularly the types of jobs that we need the most, the jobs in goods production and manufacturing. And we're continuing to add the jobs that are least productive and that we can't afford. More government jobs, more service sector jobs in education and healthcare, where we really need to be shedding jobs and getting more efficient so that we can free up labor for the things that we need. I think as more people begin to focus on the fact that there is no recovery, that it's an illusion, that it's a myth, that the reason that it's a jobless recovery is because it's not a recovery. That's why it's jobless. If it was a recovery, there would be jobs. And as this starts to sink in, I think that's really going to compound the worries for the dollar, because people are not only going to worry about the spending side of the deficits, but the revenue side. Not only is the government spending more money, but it's collecting less in the way of taxes as more and more Americans are losing their jobs. Anyway, later on tonight, I am going to be appearing in the first of the televised debates here in Connecticut for the Senate. The two Democrats vying for the Democrat nomination debated last night on television. This evening, it will be me and my two opponents. So if you don't live in Connecticut, you won't be able to watch on television. Well, I do believe there might be a website that's streaming the debate live, but if not, I'm sure somebody in Connecticut will likely record the debate and post it on YouTube. So I would probably encourage people to look for any kind of YouTube broadcast of the debate. You know, they call them debates, but they're really not debates. There's going to be very little interaction among the candidates. We certainly can't ask each other questions and contradict in any real manner. So they're not debates. They're really joint press conferences where the three of us have an opportunity to make statements in 1-minute increments. And I think I get a 2-minute summation. But it is going to be the first time that many people in the state of Connecticut actually know that I'm in the race. I'm sure many people tuning in are going to be surprised to see 3 podiums there. They're going to be wondering who the third candidate is, because very little has been written about me in the press. Anyway, take care. That's it for today. So long.